Luke Gromen, founder of FFTT, Forest for the Trees. It is so great to see you again, Luke, and it is so wonderful to welcome you back to the show. I feel like it's been way too long, and we always love having you on. Thank you so much for taking the time to join me today.
Well, thanks for having me back on, Julia. It's great to be here.
Well, it's always wonderful to have you. And gosh, last time we had you would have been the very end of 2024, right before we kicked off the 2025 year. And I always say this, I feel like so much has happened, but a lot certainly has happened, and we can take this in so many different directions with everything that's transpiring in the world. But it would be great to just start more of the big picture like we always do, Luke. So let's start there, that big picture, more of that macro view, where we are today, how you're thinking about your outlook as it relates to the economy, markets. And as you know, Luke, you can take all the time you need to set the table when it comes to that big picture, more of that macro view.
Yeah, thanks. It's there's a lot going on. It's a very murky picture. There's a lot of moving parts. Um, and I'll give you an example. As I look across, I'm watching a disconnect over the last 2 years since I think a big moment, if we go back 2 years ago, was when the Bank of Japan lifted the ceiling on 10-year yield, 10-year JGB yield curve control, because the yen has been a major funding currency for years slash decades. Uh, Ever since the BOJ did that, we have had a correlation between stronger yen means lower 10-year Japanese 10-year bond yields, and a weaker dollar means lower 10-year treasury yields. And those relationships have held for the last 2 years. In the last several months, both of those relationships have broken. In other words, they've diverged. So you're no longer getting a stronger yen driving lower 10-year JGB yields. That's a problem. And you're no longer getting lower dollar driving lower 10-year yields. Also a problem. Um, because those are the two biggest funding currencies in the world, the yen and the dollar. So there's a lot of people around the world that are short them, and now you're in this situation where uh, it's essentially a signal that the central banks of both of those nations are cornered in some level. They're going to have to make a big choice. They're going to have to choose sacrifice the currency or sacrifice the bond market. If you sacrifice the bond market, you're going to sacrifice the government. In other words, you're going to let rates rise. So that's a problem. You look at the fiscal side. The United States is already at 100% of true interest expense, entitlements plus interest. And now we're talking about ramping up DOD spend, the DOGE conversations and the austerity and all this stuff that has disappeared, like the warden in Shawshank Redemption says, like a fart in the wind, right? So you've got this divergence in the two biggest funding currencies, bond markets versus currency, suggesting two major central banks are cornered and they're going to have to make a choice. You've got the fiscal side of the reserve currency issuer, the U.S., already sort of into full fiscal dominance and just basically hitting full send, as my kids like to say, in terms of let's just spend more on defense. Um, Into those things, you've got physical world constraints that I don't think enough people on Wall Street are paying attention to. Rare earths, for example. We have had the Secretary of State, we've had the Vice President, we've had the President talking about rare earths. So much so that a month ago, Secretary of State Rubio said we can't go to war without these things. And where do we get them all? We get them all from China, at least from a refining basis. So we have a rare earth constraint. We have an electrical grid constraint within all of this. One of the things we never consider costs of our opportunity costs. U.S. electrical generation has not grown in 20 years. While we were off fighting to achieve not really a whole lot in the Middle East, China's grid exploded in terms of their generation capacity, et cetera, while our electrical generation capacity hasn't really risen, which is a problem because now with AI, the grid's the constraint. And so we are constrained in this AI situation. We're also constrained on labor. which is not popular to say, or not well understood not that it's popular or not, it's not well understood. In New York, it's not well understood in Washington, where the answer for 25, 30 years has been, oh, we're short, print. You can't print welders. You can't print skilled trades. You can't print engineers. And so not only do we have issues with the grid, issues with rare earths that you can't print, but we have a skilled trade issue, an engineer issue that you can't bring immigration in. This is not a situation you just open the borders and we're going to have a bunch of engineers and welders in 4 months. That's not how it works. It takes years, and we don't have years. So you're running into physical world constraints that can't be printed. And then layering on top of all of that, you have AI that is getting clearer and clearer, going to be a severe deflationary impact to wages and to white collar wages. This discomfort among white collar wages, medical worker wages, uh, is something I recall vividly 20 years ago when China went into the WTO. This is just, we know how this plays out here in the Rust Belt, how AI is going to play out. It's just a question of how long it takes. But like China was the first AI. China was the first productivity miracle. It just didn't hit white collar workers. It only hit blue collar workers. So we know how that's going to go, which is I think, difficult for the system as it's structured, because ultimately AI doesn't pay taxes and people do. And so the tax base is going to get undercut by AI. The ability to pay mortgages for white collar workers is going to decline. And then you get quickly to a situation where it's sort of deflationary until we need to start printing the money to to pay the entitlements, the interest on the debt that we have, the defense bill that is going to rise meaningfully according to NATO and Trump again, even today as we're sitting here talking. So there's a lot of crosswinds, and there's not a lot of easy solutions anymore within those crosswinds. There's all degrees of um, difficulty. Someone's got to take pain, and no one wants to take pain. We're in a society where no one's ever had to take pain in their adult lifetimes, and that's starting to change. So it's a very interesting time. There's a lot of different ways depending on which buttons you push, which issues of those four things I addressed that you try to deal with in terms of order of operations. You can have different outcomes. Most likely outcome to me is going to be some form of, brief deflationary issue followed by sort of, go back to growing the Fed balance sheet again because there's no other option.
Wow, what a great frame up to the conversation as you put out like all these different crosswinds taking place, different outcomes. And as we're recording this on Wednesday, June 25th, I'm just looking at like the headlines are S&P is about to reach new record highs. It sounds to me like there might be like when I hear you talk about this, like it sounds to me like there might be a disconnect in the markets, and are folks being complacent then?
No, I think some people are, but I think the bigger meta trade that has been ongoing for years and I think is going to accelerate is get out of government liabilities and get into private liabilities and nobody's liability, right? So I would rather own Apple bonds than U.S. Treasury bonds. All
Hmm.
else equal, the same tenor. I would rather own Microsoft bonds and I'd rather own Microsoft and Apple stock than U.S. Treasury bonds. I would rather own gold and Bitcoin relative to both bonds and stocks. And we're seeing, this. So it's a very familiar market action if you've been in emerging markets. It's get out of the government's liabilities and get into something that's going to hold its value in real terms a bit better. But it's something very unfamiliar to most Americans who are still, many of whom are still sitting in 60-40 portfolios, 40% bonds, a big chunk of those government
Yeah.
bonds. Um, and you're seeing this divergence already. Where I saw a great chart a couple weeks ago. It showed, all right, so gold prices in dollars row started breaking out first. Then gold prices in bonds started breaking out, and now gold prices in dollars, or excuse me, gold prices in stocks have been rising year to date. And
Mm.
so that I think is gonna well, there'll be puts and takes to it, but I think over time, that's the meta trade we're watching, which is, you know, we can see the divergence that we were talking about before, which are pretending some version of a disruption or brief crisis. We can see the fiscal side, which is, they're not going to cut off boomers. They're raising defense spending. So they're going to have to slash rates. You've got sort of 4 or 5 different Trump officials begging, literally begging. Lutnick's on Twitter again today, begging for rate cuts, begging.
Yeah.
And why are they begging? They're begging because they know they're cornered. Like they can't cut defense, they can't cut entitlements, or they'll be voted out unceremoniously. So they got to cut interest to make room in the budget. They know the physical world constraints are what they are. Otherwise, I think that's a big part of the reason we signed, this big AI deal over in the Middle East, where all of a sudden we're going to put a bunch of AI infrastructure in Saudi and UAE. Like, it's always kind of trumpeted as, hey, this is always to our highest and best. And sometimes it is, sometimes it's not. Sometimes it's, holy crap, we spent 20 years fighting the Taliban and to take Afghanistan from them and then give it back to them. And so instead of investing in our grid like China was doing now, we're in this AI contest with China, their words, not mine. And we don't have the grid. Like there's warnings of brownouts in middle Ohio. Well, what's the significance of middle Ohio? Google where a bunch of hyperscalers are going in. Columbus, Ohio region. Google,
Yeah.
Amazon, etc. They don't have the grid. They don't have the grid. So what do? You're like, hey, we're going to put it in UAE and Saudi. Hey, look, this is a great partnership. And it might be a great partnership. I don't know. But it's being, I think, done out of necessity to basically sort of make up for stuff. So that's why I think what we're watching in the markets is just this growing realization of like, and you can see it in the data, right? If you look at the Citi Economic Surprise Index, it is on the lows of the past 12 months. 10-year yields aren't coming down. Like they're whatever. People say, well, they're down 60 basis points off the highs. They were at 495 for a second, right? They're really down 40 basis points. And oh, by the way, they were supposed to go down when Bessent, when markets fell earlier this year, and they did for like 5 days and then bounced. So they're in a pinch, and I think there's this growing recognition, like the fiscal situation's cooked. And when the fiscal situation's cooked, you get out of long-term government bonds, you get into gold, Bitcoin, stocks, houses, hard assets.
Yeah, the move into hard assets. And I've had other guests say something similar too. And I suppose like gold's probably already sniffed this out, or is it just beginning to sniff it out? Sounds like maybe there's still a lot more room to run because we might even be early innings in this too.
I think it's still early innings. I mean, some of the technicals you say, oh, maybe they're a bit stretched, whatever. Some of the shorter term traders will tell you, and they might even be right. But you can't the sort of a corollary to the meta trade that is ongoing and accelerating, which is you got to get out of government liabilities into private harder asset liabilities, is you can't use these liabilities to settle trade. And so when we see things like the European Central Bank last week come out with a report, it was reported all over. If you include gold in FX reserves, the dollar's share of global FX reserves has gone from 60% in 2015 to 46% today. Gold's up to 20%, and other currencies, the yuan, is been a big share gain up to I think 16%. And that's a function of central banks buying gold and the function and central banks or gold's price. So the central banks are looking at this, particularly in Eurasia, across Eurasia, are looking at this and going, the Americans literally can't make their math work at all unless they run real negative interest rates of probably -5, -10, -15% for an extended period of time. Well, I can't settle trade in that. I might as well settle trade in confetti paper. So they're buying gold. They're net settling in gold. And so this, I think it's very difficult to get off this train once you're on it.
You pointed out that you've had a bunch of Trump officials like basically begging for rate cuts. You've had, President Trump post on social media criticizing Powell, like demanding rate cuts as well. And they're cornered, as you point out. Do you have any sort of outlook for the remainder of the year as it relates to rate cuts? Do you see cuts happening in the remainder of the year? What's more of your viewpoint there as it relates to the Fed?
I don't know. I think you probably do, but I don't have a strong view on it. I just look at it as, you had Trump begging twice last week, calling Powell stupid, called him stupid again
Yeah.
today. Lutnick
Yep.
has begged twice. Pulte has begged two or three times. Besant is at least a little bit more sophisticated about it, right? He has upgraded his stablecoin estimate to buy T-bills from 2 trillion 2 weeks ago to 3.7 trillion last week. So like, by 2030, 3.7 trillion in stablecoins at a 0% yield because the Genius bill, by the way, just banned stablecoin issuers from paying interest. So they're 0%. So they're teeing this thing up to take rates to stablecoins to zero. And then the stablecoins have to buy the T-bills. 3.7 trillion at 0% T-bills. Like a 0% T-bill is the kissing cousin of dollars, right? A dollar is at its core a 0% yielding bond of zero duration. It's a 0% yielding T-bill of zero duration. That's all a dollar is. It says Federal Reserve note on it. So if you're going to finance 3.7 trillion in deficits over the next 5 years in 0% yielding T-bills, that's the polite way of saying we're just going to print 3.7 trillion. We're going to print the kissing cousin of 3.7 trillion dollars to finance deficits, which is kind of where they are. So I don't have a strong view on rate cuts. I think they'll cut rates. The data is certainly softening to sort of justify that. I don't think the 10-year yield's going to come down like a lot of people think they will when they cut. Even if the data keeps slowing, because the reality is like entitlements and interest alone are 100% of receipts. The receipts are all-time highs. And so as the data slows, receipts are going to fall. And so you quickly get into this, you know, this crowding out dynamic. Print the money to finance it, or you're going to get, dollar up, everything else down and rate, including bonds, including, yields up until you do print it or its equivalent, whatever that looks like.
Yeah. The last time you and I spoke, which again was the end of last year, we did talk about the US dollar. And I think we were even talking about the Doge back then, if I recall correctly, that you would need to weaken the dollar before you could even Doge. I feel like we're not even talking about Doge anymore these days. But the dollar, the US dollar kind of being a cornerstone, is that fair to say, of the outlook? And help me kind of understand, help me unpack the mechanics and the implications here. What this would mean for portfolios. Like, help us understand the thesis a bit more as it relates to the dollar.
Yeah, I think ultimately it is they need a weaker dollar still. I think when we were saying that late December or whenever we talked in later in last year, the dollar was DXY was still, I think, over 100. It's now down to whatever, 97, 98. It's got to go lower. But it can't go lower too fast, because if it does that, then it increases the risk of inflation on the other side. But if it goes higher, it's going to short squeeze. There's still $13 trillion of foreign dollar denominated debt out there. And offsetting that is $23 trillion all in on a net basis of foreign dollar held assets. So foreigners aren't short. They're short $13 trillion in dollar debt. That's a dollar short. They're not short dollars though, because they own $22 trillion of dollar assets. So dollar gets too strong, they will sell bonds, they will sell stocks. Stocks get too weak, they'll sell bonds. They'll sell bonds because receipts are tied to stocks. They got to keep the dollar moving down in sort of an orderly fashion, or else the math just doesn't work.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: Why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. And as you also pointed out at the top of the conversation too, like I thought this was interesting. I wrote down the note here around the weaker dollar would mean lower 10-year treasury yields, but those relationships have broken, they've diverged. Can you talk a bit more about that kind of disconnect that we've seen and the implications there, especially if you see more on the bond market side?
Yeah, if you look at the past several years, there was let's go back in time a bit to sort of 2019. There was stronger dollar, and the stronger dollar. Let's back up. There's $13 trillion in dollar-denominated borrowing. There's $22 trillion net. I want to say almost 60 trillion gross of dollar-denominated assets held by foreigners. Every time the dollar's gotten too strong, foreigners have sold treasury bonds first. And so in risk off since really late 2018, but particularly 2019, 2020, 1Q20, 3Q22, 1Q23, 3Q23, 1Q24, again earlier this year, 1Q25, anytime the dollar has gotten too strong or anytime there has been risk off, you get a brief decline in 10-year treasury yields, and then 10-year yields start rising. In other words, bonds start being sold alongside stocks. And then liquidity is added one way or another, and sort of that stabilizes. That's been the pattern. We'd been saying since summer of 2022, as we were watching the dollar go up and up and up, as Powell was raising rates, and consensus on Wall Street was he's going to be the next Volcker, even if he has to induce a recession. And we were saying basically that, this isn't going to go the way you think it is. And what we were saying at that time was because the debt is so high, by raising rates, all he was doing is increasing the deficit, which is stimulative, not contractionary. And that's exactly what he did. And what we said was ultimately because they didn't let inflation run high enough for long enough, right? Everyone said, "Oh, rates higher for longer." So the Fed screwed up not by acting too late. The Fed screwed up by acting too early on inflation. They shouldn't have raised rates. They should have let inflation run hot through 22, through 23. They could have gotten the debt to GDP down. They could have kept doing QE. We would have had our bad inflation. Biden would have gotten, they would have gotten crushed in midterms. He would have gotten crushed in the election, but we'd be in a better shape as a country. What we said in summer of 2022 was by Powell trying to be Volcker, he's setting himself up for a moment where his choice is how he wants to lose the long end of the bond market. He can do it by cutting or he can do it by hiking. And we saw them kind of try to split the baby, if you will, ride two horses with one ass in 3Q22, where Yellen kind of stepped in from Treasury and started running down the TGA to offset Powell's QT. We saw Powell come in and unwind his own QT with BTFP, but only for the banks in 1Q23. We saw 3Q23 with dollar weakening and more Treasury as a result of more Treasury dysfunction. And in 3Q24, there were a whole lot of people that were saying, well, why is Powell cutting rates 50 basis points in September? And we were saying at the time, it's a Treasury market. You were seeing rising Treasury volatility rates, implied volatility, Treasury move index, because foreigners are not buying enough Treasuries. Foreign central banks have not bought a single Treasury on net in 11 years. It's all private sector. A lot of it is, hedge funds and tax shelters. I mean, the Cayman Islands, I think, population 65,000, I think is now the United States' fourth biggest foreign creditor, right? That's hedge funds. UK is number 3, I think, maybe even number 2. They might have surpassed China. Again, UK runs twin deficits. That ain't based on trade or trying to manage the value of the pound. Those are hedge funds. Those are funds. They sell when Treasury vol rises. So uh, Powell cut rates, and a lot of people said, "Wow, the 10-year sold off on him cutting rates." That's not what I expected. It was exactly what I expected. Like how he chose, and now here we are again. A little bit of the same thing. Is he going to cut in the second half? I don't think the 10-year at the long end is going to come down much at all. He's
I think it's
stuck.
going to
If
go
he
up. Yeah.
lets the economy continue to weaken, receipts are going to go below interest on the debt and entitlements. And so we're not going to cut, interest won't come down. It's only going to go up actually because it's still below market, if you will, right? In other words, the weighted average coupon on the debt, I think it's still in the threes. It's on its way to 4 on 37 trillion in debt. So that's going to keep going up. Entitlements aren't going to get cut. Entitlements are growing 2 to 3 times faster than receipts because boomers. And look around you. We're not exactly getting healthier as a society. And now we're throwing war on top of that. That's not, that's, more defense spending. That's neither here nor there. But so like if he doesn't cut rates, then we're going to get into a potential moment where, you get dollar up, bonds down, stocks down until they have to react. And if he does cut, you're going to get stimulative. I think, maybe we get a momentary decline in the 10-year yield, but not by much, not nearly as much as all the bulls think. And then I think it's going to take off like a scalded cat, like it did last September. And then again, I think he's really going to be exposed. Pete Powell's really going to be exposed to exactly how cornered he is, which is, to the first point, that's what the divergence between dollar yen and, the yen and the 10-year JGB yield and the dollar and the 10-year Treasury yield. That's what it's telling us. That's what the divergence between gold and inverted U.S. real rates is telling us. They're stuck. They're stuck. So that's why I don't have a strong feeling on rates. If people ask me at the time, what did I think Powell should think? What do I think he should do? I think he should go get in a time machine, go back to December 21 and resign when he was still considered like the hero for fixing COVID, because it's all downhill from there.
So either you don't see any potential solutions, and like he's just stuck. It's just that.
Well, there's solutions. There's just, the solution is there's a rock hanging over two people's heads, and whose head does Powell want to drop it on? And when I say rock, I mean like the friggin' boulder in Indiana Jones, right? Like, do you want to drop that on the dollar, or do you want to drop that on the bond market? Basically that's his choice.
And they
He's got to
probably
crush the
can't.
dollar,
Yeah.
or he's got to crush the bond market.
Which one do you think's
And by the way, if he crushes the bond market, literally he's going to crush the dollar like 2 months later, because yields will spike. And as soon as the market sniffs out that, oh my God, interest is way, they can never do this because the receipts are interest rate sensitive. So the receipts will decline non-linearly. And their interest, at 120% debt to GDP, their deficits are going to rise non-linearly with it. The market will sell the dollar then either way.
Mm-hmm.
He's stuck.
Okay.
He screwed up in 22. He needed to let inflation run hot.
Okay. I'm also just looking. The last time you and I spoke, I want to say that our U.S. debt was probably just north of 36 trillion. It's now obviously it's north of 37 trillion. And you also point out like entitlements are still increasing. Like the math just does not look good. And you also kind of brought up this point. We were doing like all of this deficit spending too. Like we weren't in a wartime either. So it kind of makes me wonder too, the fiscal picture, and there is heightened geopolitical risk out there as well. How do you think about, I guess, how do you think about that risk and the fiscal picture? Like, I don't know, is there a way the math could work out? Or I know you don't like the term end game or anything like that, but how do you think this plays out?
Yeah, there's a way that math. Yeah, I think that there's ways the math can work, right? Look, if we have negative 15% interest rates, real interest rates, right? We run inflation at 15, and we have the Fed pin rates at 0. Math works fine. Math
Yeah,
works
but that'd be
fine.
very
If you're a
painful.
bondholder,
Yeah.
for bondholders, not for gold holders or Bitcoin holders or equity holders or if we constrain, if we close the borders as well, be great for wages. It'd be terrible for business. It's bad for profits. It's bad for, profit margins. It's great for profit dollars, right? Profit dollars will go through the roof. Profit margins will tank. Investment will surge because if we close the borders, there's everyone and their mothers going to be trying to invest in productive assets and capital to try to replace labor whose wages will be going through the roof. Labor will love it because they'll be getting 15-20% wage increases while the Fed's got their mortgage pinned at 2. It's bondholders and Wall Street lose. Washington wins because their real value, their deficit collapses. Inflation surges. Politicians hate it because inflation's going to go nuts. They're all going to get voted out of office in 6 months. But you know what? Be better. They made these choices. Yeah, the math can work that way. The math could also work as if boomer mortality spikes in the next 24 months. Math works great, right? You've got 70% of receipts, which are at all-time highs and tied to the stock market, go to entitlement boomers or boomer entitlements. If, you can do the math. If there was a sudden spike in mortality, the math starts to work again. Look, I don't think it's going to happen, but there are ways the math can work. That's why I say, there's no pleasant ways the math can work. Productivity miracle. If it arrives fast enough, because we're already sort of past the threshold, let's have a productivity miracle. AI. Well, AI is going to, let's say it shows up faster and does more than we think. Well, arrives faster and does more than we think means a whole bunch of white collar people are going to lose their jobs. And a whole bunch of white collar people have mortgages and car loans. And when they lose their jobs, what do? This is what I meant earlier about, China was the first AI. I know what they do. They stop paying. I saw it here when, the Ford guys and the GM guys went from making 30 an hour full bennies to $12 an hour at Walmart, no bennies. They stopped making payments on the bass boat and on the truck. And then finally on the house. And then the banks start going kaboom. And so that's not that's why I say we could get a moment of deflation. But then you go, okay, is the Fed going to sit there and let their banks blow up because AI has crushed the consumer loan market and the mortgage market? No, not in my opinion. They're going to print every dollar they need. Then we're right back. So, there are solutions. There's always solutions. There's no end game. There's just, once you do enough dumb stuff on borrowed money and it's completely uneconomic, unproductive, right? I mean, in 2001, when we had 6 trillion in debt, we have put on 31 trillion in debt in 25 years. What have we gotten for that 25 trillion? What have we gotten? Do we have the best highways in the world?
No, and our airports.
Do we have an amazing high-speed rail system? How are our airports, right? Go overseas and tell me how our airport. What have we gotten? Nothing. And so in the end, economics hold, right? And if you spend as a company, if you spend 25 billion, you have a $25 billion company and you spend 25 billion on debt and you take it and blow it all on red in a single trip to Vegas, now it's gone. The equity value of your company suffers. Well, we blew $35 trillion going to Vegas, going to the Middle East and betting it all on red, and we lost. But countries, they don't have their equity get wiped out to zero. They just print the money and refill and go bet on red again. So that's the practical, example of what I'm talking about. Yeah. It's just changed the rules. And so there's solutions. It's not that there's not solutions. It's just that nobody wants the solution. The solution is Powell's got a huge boulder holding it over the heads of either people who hold dollars or people who hold bonds, and over the dollar or over bonds, right? And he's got to let it drop on one of them. Mm-hmm. And if he drops it on the people holding bonds, he's going to drop it on the people ahead holding stocks. And he's going to hold it paradoxically, that will also crush his own receipts because if stocks fall, receipts fall. And he creates a debt crisis either way. So he might as well get his money worth. He screwed up by not letting inflation run higher for longer. Now he's going to have to.
It also makes me want to bring up a point that you brought up earlier. And you are one of a handful of guests who's talked about this, and that's fiscal dominance as well. I would love to hear more on the fiscal dominance side of things. Are we already in fiscal dominance? And I believe in the past, you've referred to that as kind of this shadow third mandate for the Fed of like realizing the fiscal dominance?
We are in it, and it is a question at any given moment in time. There are degrees of fiscal dominance, right? So for me, once true interest expense is over, call it 95% of receipts, then yes, 100% we're in fiscal dominance. The way you get out of it is you've got to let real interest rates be significantly negative. You got to let stocks rip because stocks drive marginal receipts in this country via consumption. So if you let real interest rates be, I don't know, -5%, right? So inflation running 5 points above where rates are, and stocks are rising 20, 30% per year for several years, you're going to quickly have a receipt boom. And when you have a receipt boom, you will actually grow your receipts faster than those other line items. Particularly if you can lie to the people about exactly what inflation is, so they don't their cost of living adjustments and entitlements don't ratchet up as quickly. And like if you have 2 to 3 years and -5% real rates and 20 to 30% increase in S&P, like you get what we got in 2020 and 2021, which is the deficit went from 3.1 trillion to 1.4 trillion in 2 years. True interest expense as a percent of receipts went from 105 to 85 in 2 years. Like there's always a solution, but it's Jean-Claude Juncker said it like 10 years ago. And we all know what we need to do. We don't know how to get reelected after we've done it. That's where we are. Like they know exactly how to do it. But again, the dollar's got to get killed. Inflation's got to surge. Bonds got to get killed either nominally or on a real basis. They can't get killed nominally, so they got to get killed on a real basis. And that's going to honk a bunch of people off, and then they're not going to get reelected. So they're the squawking from the Trump administration, I think, is them realizing like, oh God, DOGE didn't work.
Yeah. I feel like you were probably pretty skeptical of Doge going into it.
Oh yeah.
Yeah.
I mean, I said, look, if they don't devalue the dollar first, it's not going to work. And, people said, oh, well, don't worry. He's going to let risk assets fall. And when they let risk assets fall, when they let stocks fall, there'll be a rush into 10-year yields. They get 10 years down to term out the debt. That's what they're going to do. We're going to cut. We're going to let stocks fall. And that will drive 10-year yields down well into the threes, into the low threes, maybe even lower. And then he's going to term out the debt. And I said, unless they devalue the heck out of the dollar first, like they're smoking crack. And I was right. They were wrong. Stocks went down. Bonds went down at first. Like, oh, see, it's working. It's working. I was like, wait for it. Wait for it. Boom.
There
6 days in, 10-year yields start taking off. And all of a sudden, like, now what, wise guy? What are you going to do? Like, your stocks are down, which means your receipts are going to be down. Your yields are up. It showed a gross misunderstanding on the market's part, on consensus's part, and on policymakers' part of how the whole thing's working.
You were right
And then
because
DOGE, I was like it's, yeah, DOGE, like cutting DOGE. Like, I'm like, dude, we're going to cut a bunch. I'm like, you are spending 120% of receipts on entitlements, interest, and defense. You're not going to cut defense. You're not going to cut entitlements. We're going to strengthen the dollar, not by cutting rates enough. Look, that was the only thing you can cut is interest. And Powell's not cutting rates for you. So what are you going to cut? And sure enough, well, we thought it was 2 trillion. It's actually a trillion. It's actually 14 billion or whatever it was. Some like ridiculous 130 billion. It was like a stupidly low percentage of what they thought they were going to cut.
you were right because even I remember that. And it was like a couple months after the interview, like people were still in the comment section commenting on your interview because I think people went back and watched it as well. All right. Maybe just to reemphasize from an investor perspective, like how you want to be allocated. You mentioned hard assets, gold, Bitcoin being another. I do want to hear your thoughts on Bitcoin, but and obviously avoiding these kind of government-backed treasuries, especially on the long end of the curve. So maybe just walk us
Yes,
through
and the
how you
long end.
think
Like
that.
I've got a big position. Yeah.
Yeah, you have
Yeah, I got a
T-bills,
big
I
position in
think.
T-bills. Like I think
Yeah.
T-bills are fine. Yeah.
Mhm.
how I want to be positioned is low over my skis because I'm overweight gold, I'm overweight T-bills, I'm overweight Bitcoin. Um, I think the U.S. government sees stable coins, they very clearly see it as a way to financially repress and create an ability to finance deficits at very low rates. Besant can't get 3.7 trillion or 2 trillion even in stablecoin T-bill buying over the next 5 years without Bitcoin probably being a multiple of where it is today. It's very hard to see a world where the stablecoin market cap is bigger than the Bitcoin market cap, let alone. And as a practical matter, going back the last 3, 4 years, whatever the market cap of total stablecoins, Bitcoin has never been less than 2.5 times that, and it's been as high as 10 to 12 times that. Right. So if Besant's talking about 3.7 trillion in stablecoins by 2030, in my opinion, he's talking about 8 trillion, 9 trillion Bitcoin, up from 2 trillion today, 2.1 trillion today, or up to 30 trillion Bitcoin, up from 2 trillion today. Like the US government now needs much higher Bitcoin to achieve their stable coin goals. So that's, I think, really interesting. And other than that, like I'm sort of very low over my skis because there are real constraints that are not priced in right now. The dollar, 10-year yield and yen, 10-year JGB divergences, that's a problem. And I don't know what's going to trigger it. The United States can't go to war without Chinese rare earths. I know we just had this glorious victory, and look, regardless of what one thinks, I think it makes sense to make sure the Iranians can't get a nuclear missile. A nuclear weapon. I understand that. Great. I think it was a great limited raid. It was successful. No Americans were hurt. That is awesome. And the reality still exists. We can't fight a war of any duration without Chinese rare earths. So, in addition to being a very efficient raid, it was also very efficient marketing. Even if we wanted to have a lengthy war, we can't without Chinese rare earths. There are real constraints. How do those real constraints manifest themselves? I don't know. I don't know if that freaks markets out or if markets go, oh gosh, there can't be a war. The Americans can't go to war. Oh, I don't need to own bonds. I need to own stocks, right? I need the hard asset play, right? I don't know. I see things on the grid and on the labor side, like they're inflationary, full stop. I see things on the A side, it's very deflationary for a moment. And then again, I've seen how that worked here in the Rust Belt. People stop paying their boat loans and their car loans and then their mortgages if they get displaced. And that's what's coming for white collar. And I don't know if that's coming. It's probably not coming in the second half of this year, but it probably starts second half of next year and the markets look 6, 9 months ahead. I don't know how to weigh all those things, but that's where I kind of shake out for the moment until I get more clarity. Especially seeing where the fiscal is, there's a reason they're all begging for their rate cuts. They know they're cornered. Powell. So where do I think, let me lay out two scenarios.
Mhm.
I think it's one of two most likely scenarios are sort of my base case. The first is Powell continues to not cut rates and we have an economic slowdown, and the dollar starts to rise. And then all of a sudden, 10-year yields start rising, and 10-year Treasury yields hit 4.6, 4.7, and all of a sudden, stock market starts to fall, and it starts to fall sharply. And then 10-year yields go back to 4.4, and then they, for maybe 5 or 6 days, and then they take off back toward 5. And now Powell's facing a rapidly slowing economy and a falling stock market and a rising long end, and he has to cut into that. That's scenario one. And then we get the softer dollar, and then I think Bitcoin rips, gold rips, but stocks rip. Scenario two, I think, is he cuts, and the dollar goes from 98 today towards, I don't know, 90 by year end, and that is like party on Wayne, party on Garth. I think for everything except the long end of the curve. I think the long end probably doesn't go up as much in that case. It probably goes from 4.3, where we are today, 4.35 to, it probably panics at first to 4.45, 4.6. but then back comes back down to the surprise of a lot of people to 4.4, 4.5, which is fine. Bitcoin rips, gold rips, stocks rip, and like inflation starts picking back up by the end of the year, and then we can deal with that in the first half of 26 is our concern. But those are my two, like if I laid those two scenarios out, I'd probably say there's a 60% chance of the second scenario. I'd say there's probably a 30% chance for 35% chance of the first scenario. And, sort of fill in the blank. There's some other things that are, they used to be 1% tail risks and now they're, 10% tail risks.
What for you is the biggest risk that's keeping you up at night? And maybe to end on a positive note too, what's something that's making you optimistic? So two-part question.
What is something that keeps me up at night?
It doesn't have to literally keep you up at
Um,
night, but something that's on your mind. Yeah, the biggest risk.
Look, where I'm gonna be, yeah, where I'm gonna be like totally wrong and have to completely like if there's one thing where he's like that changed, if you had like significant regime change in China and or Russia, like where all of a sudden we get a new Yeltsin who's just willing to, sell off the Russian, you know, sell off Russia to Western oligarchs piecemeal, all in dollars, that would force me to change things. I think if we had some sort of new regime where in China, the leader suddenly is like, hey, all we want to do is own treasury bonds, yielding, -5% real rates. And, we're gonna not, we're basically gonna go back to sort of 2001 China. And that would force me to have to completely do an about face. That would change things. That would certainly buy time for the fiscal situation. I think there's almost zero chance of both of those things happening, for a number of reasons. But those kind of things are the things where I kind of go, okay, where as I'm constantly thinking about where are my blind spots in this. Those are two of the biggest. Uh, and sorry, the second question was what? Something
Yeah, something
I'm
that you're
optimistic
optimistic
about.
on. Yeah.
Look, I'm optimistic that the world, by the time my kids are adults and having kids, are going to be in a much better spot. Like, look, the boomers have screwed this all up. And it's not just their fault. Their parents, them, like no one wanted to be an adult. There was no political courage. In 1989, we should have had a new monetary conference where we rebalancing, basically a new Bretton Woods. And instead, the leadership of the time said, you know what, we have a unipolar moment, and we're going to do this. And the success of that unipolar system sowed the seeds for its own demise. And that's what we're watching. You know, and so I think ultimately the thing to be optimistic about is over the next 5 years, I think you're going to get a significant decline in U.S. debt to GDP on a real basis, one way or another. It just depends on how they get there, how they do that restructuring. And then on the other side of this, you've got some very promising new technologies, things for healthcare. I think, some of the things that Bitcoin brings to the world, in terms of monetary system reform, some of the things that are being done with gold, monetary system reform as a neutral reserve asset, those things I think will ultimately, it's going to be a much better world for, in 5 to 7 years for my kids as they become adults. I mean, they're technically already adults, but they're, very young adults. So, I'm very optimistic about that. Like I said, there's always solutions to these things, right? They always work out in the end. There's just, what's normal for the spider is chaos for the fly. And I think what's coming is, if you're a long-term bondholder, government bondholder, I think the next 5 to 7 years are going to look a lot like a spider to you, and you're the fly. And that's, on a real basis. You're going to get paid every dollar you're owed. They can't make their math work unless they really repress you. They're telling you that. They're begging for it. Like when they tell you that, you should probably believe them.
Yeah. A quick question on the long-term bondholders? Are those are the suckers at the table, I take it. And are they hedge funds or is it retail investors?
It's retail investors, as usual. Um, you can look at every quarter, the Treasury Borrowing Advisory Committee puts out a report, excellent report, it must read. And it shows what groups have been, amongst all the other information, what groups have been the buyers of the latest Treasury auctions by tenor. So they have one that's of bills, they have one that's 2, 3, 5 the belly of the curve, and then they've got 7, 10, 20, and 30 years. Like I look at 2, 3, 5, and then 7, 10, 20, 30. I go back to 2011, 2012, what they call investment funds, which is in my view, a proxy for retail. That was 11, 12, 15%, those auctions. It's 70 to 75% now. Foreigners
Mm.
back then were 40, 50. They're down to like, 10, 12. So like, yeah, they've loaded retirement funds and mom and pop retail up with mid to long-term treasury bonds. This is the first cycle where those groups aren't the suckers at the card table. Like it'll be the first time in my 30-year career because they're always the suckers at the card tables and everything else. .com, they were the sucker at the card table. Housing, they were the sucker at the card table. Inflation, they were the sucker at the card table. So like, and yet, like that's fair, right? We try to find the most politically balanced solution. The reality is, again, that generation is getting 70% of tax receipts that are at all-time highs in entitlements. How does that make any sense for my kids? I don't know if you have kids, for your kids, for any of the younger generation. It's not like our educational system's killing it. It's not like our, healthcare for poor children is killing it. No, they're talking about making cuts to that stuff. Why? So that the wealthiest generation in the history of mankind can get 70% of receipts? How does that make any sense? So
Crazy, yeah.
it's actually it's basically raising taxes on the boomers without raising taxes on the boomers. Get them loaded into this paper and then devalue it. Their stocks will still go up. And you know what? Like you got to pay more for what, I'm changing the deal. You got to pay more for it. It's as close to fair as you can get. Hey, you have to pay for what you're using.
Luke, I have to say, I love having you on. You are such an incredible voice in the macro world, and I know this audience loves listening to you. Before I let you go, let folks know where they can find more of your work. I know you have a subscription as well to your Tree Rings newsletter. So the floor is all yours. Anything that you want to plug, it is all yours.
Thank you. I appreciate those kind words. Yeah, if people are interested in learning more about our mass market and institutional investment products, investment research products, they can go to FFTT-LLC.com. And then you can also find me on X at Luke Gromen, LukeGromen.
Luke Gromen, founder of FFTT. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, helping us all learn and get better. And I mean it, we really look forward to having you on this show. You are always welcome. Really appreciate you taking the time today, Luke.
Thank you very much for having me back on, Julie. I appreciate it.